Imagine a ripple turning into a tsunami almost overnight, leaving investors scrambling for solid ground. How could something seemingly stable crumble so fast, transforming into widespread panic and a race to liquidate assets? The 2008 financial crisis saw instant market sell-offs, primarily due to a sudden and widespread loss of confidence in the entire financial system, triggered by the dramatic collapse of Lehman Brothers. This pivotal event revealed the deep interconnectedness of global financial institutions and the extreme fragility of markets built on complex, opaque assets. The core reason for this rapid meltdown was a systemic breakdown of trust. When Lehman Brothers, a major investment bank, failed, it signaled that no institution was too big to fail, shattering the market's previous assumptions about government bailouts. Financial institutions, unsure which of their counterparties held toxic assets or would be next to collapse, immediately ceased lending to one another. This created an instant credit freeze, paralyzing the interbank lending market, which is the lifeblood of global finance. At the heart of the crisis were housing bubbles and the widespread securitization of subprime mortgages into complex financial instruments like mortgage-backed securities, or MBS, and collateralized debt obligations, or CDO. These products had been widely distributed across the financial system, often bundled with seemingly safer assets. When the underlying mortgages defaulted en masse, the value of these MBS and CDO bundles plummeted, making it impossible to accurately price these assets or understand the true exposure of each bank. This uncertainty fueled the panic, as investors withdrew funds from institutions perceived to be vulnerable, creating a vicious cycle of asset sales and further price declines. This phenomenon of rapid value erosion and market illiquidity is sometimes referred to as a fire sale dynamic. Investors, facing margin calls or fearing further losses, were forced to sell assets quickly, often for below their intrinsic value, simply to raise cash or reduce risk. This flood of selling pushed prices down further, exacerbating the panic and contributing to a rapid, systemic deleveraging where institutions tried to shed risk all at once. Understanding these mechanisms provides valuable insight into how market psychology, financial innovation without proper regulation, and systemic interconnectedness can converge to create catastrophic, instantaneous market reactions. It underscores the critical role of trust and transparency in maintaining financial stability and preventing individual failures from spiraling into global crises.